between options and futures. An option gives the buyer the right, but not the obligation, to buy or sell a certain asset at a set price during the life of the contract. A futures contract gives the buyer the obligation to buy a certain asset. The seller has the obligation to sell and deliver the asset on a future date. Buying an option requires a premium. The premium is the most he can lose. Entering into a futures contract requires no upfront cost aside from commissions. The underlying position in a futures contract is generally much larger than it is in options. The obligation to buy or sell at a given price makes futures contracts more risky. The gain on an option can be realized by exercising the option when it's deep in the money, taking the opposite position in the market, or waiting until it expires and collecting the difference between the asset price and strike price. Gains on futures update daily to reflect current fair market value, but a futures holder can also realize gains by taking the opposite position in the market.
Now that you understand why options exist, I'm going to show you ways you can trade options to make a profit. So, most of your favorite companies that you use every day have stock options, and you can trade them right from your computer, cell phone, or tablet. There are two types of options. There are calls and puts. If you buy a call, you want the stock to go up. If you buy a put, you want the stock to go down. Now, since there are two sides to every market, you can also do the opposite, where you would sell the option as an opening trade and hopefully buy it back at a lower price as a closing trade. This will make more sense in a second. Option prices are based on three elements of its underlying stock. The first one is time to expiration. In the last video, we talked about how options are basically insurance, and of course you pay money for this insurance. Now, the thing about insurance is you don't just get to pay a one-time payment and have insurance forever. You have to pay month after month to keep your insurance. So the longer you have it, the more money you will have to pay. Options are the same way. They have expiration dates for the exact same reason you have to pay monthly for car insurance. An option with 60 days until expiration might cost $500 when the option with only 30 days to expiration only costs $250. So more time equals more money. So naturally, as time passes, an option's time value will decay. This is known as time decay. Now, let's take a look at how an option's time value will decay over time. The curve will look something like this. As you can see, time decay isn't linear, it's exponential, meaning that as you get closer to expiration, time decay will rapidly speed up. The important thing for you to understand right now is that an option's time value is always decaying, 100% of the time, every day, every hour. This can be your worst enemy if you trade options the wrong way, or it can be a huge advantage if you trade them correctly, which I'll show you in the next few videos. Most stocks have options with weekly, monthly, and quarterly expirations, and you can choose whatever expiration you want to trade in. And in some of my other videos, I talk about the best expiration that provides the lowest risk and the highest returns, so be sure to check those out. So the second factor that goes into option pricing is the price of the underlying stock itself. For each stock, there are multiple options at different price increments. These are called the option's strike price. The strike price is the predetermined price at which the shares of stock will be exchanged if the option is exercised. For example, if you own the stock at $125 per share, you could buy the 125 put because that's where you could sell your shares in case the stock goes lower and you need to exercise your option. So again, the strike price is simply the price that the shares of stock will be exchanged if the option is exercised. Of course, you don't have to own shares of stock to trade options, but the strike price of the option you're trading has a huge effect on what the option's price will be. Let me explain. Let's say the current stock price is $125 per share. For call options, any option that has a strike price above the current stock price is referred to as out of the money. If the strike price is below the stock's price, it is referred to as in the money. And for put options, it's the exact opposite. I know this is a lot to digest right now, but soon it will become second nature. So here's an idea of what each option's price will look like with, let's say, 30 days to expiration. And just a quick note, each option contract represents 100 shares of stock. So these prices have a multiplier of 100. So for example, if you buy one contract of the 125 call, this will actually cost you $500, not $5. So here's the thing. All out-of-the-money options have no value at expiration. Let me repeat. If an option is out of the money at the expiration date, it will be worthless. So if they won't have any value at the expiration, then why do they have value now? Because stock prices move, and there is a chance that the out-of-the-money options could become in the money if there is still time left to expiration. Now you can see that the further out of the money an option is, the cheaper it is. That's because the likelihood of it being of any value is less than an option that is closer to the stock price, right? Because, for example, this stock is more likely to get to 130 than it is to 135. And as stock prices move on a day-to-day basis, the option prices will also move. If the stock goes up, the calls will become more expensive and the puts will become cheaper, and vice versa. Now, a common misconception is that you have to hold your position until the expiration. This isn't true. If you buy a call option today that expires in 30 days and the stock goes up overnight and your call option is now worth $100 more than it was when you bought it, you can sell it for a profit. The expiration date of 30 days does not mean that you have to hold the position that long. Now, you see the prices of these options with 30 days left until expiration. Let's take a look at what these option prices will look like with 0 days left. You can see all out-of-the-money options are worthless, and the in-the-money options are worth the difference between the stock and the strike price. This is because since there is no time left, there is no time value left on these options. This is also referred to as extrinsic value. The third and final factor that goes into option pricing is volatility. Volatility is referred to as the magnitude of a stock's price swings. Higher volatility means bigger price swings and ultimately more risk for the investor who owns stock. Since there is more risk involved, options will be more expensive. Why would the option seller not demand more money if they're taking more risk? Let me explain. I know you're probably sick of the insurance analogy by now, but let's say you are providing life insurance for two different people. The first person is overweight, smokes a pack a day, and has a medical condition. And the second person is healthy, exercises regularly, and has no signs of any life-threatening medical conditions. Now, who do you think will have to pay more for life insurance? Exactly, the person who is at more risk of dying. Now think of this person as a stock with high volatility and this one as a stock with low volatility. Now, different stocks have different volatilities, but volatility is something that moves around. A stock with low volatility now might have high volatility in the future. Volatility is much more predictable than stock prices, so if you're trading options, it's important to position yourself on the right side of volatility. This is the backbone of my trading strategy, which you'll learn about in the next few videos. And the combination of these three elements is what determines option prices.
The profit and loss of an option position at expiration is a function of the original premium and the difference in price between the futures contract and the strike price of the option. Let's suppose you sell the 105 call for $2 in premium. The maximum profit potential for this trade is $2. Let's look at a few different possibility outcomes for the futures price at 112, 106, 100, and 94. To understand the profit and loss, let's look at the math for each of these potential scenarios. You sold the option and collected $2 in premium. For each scenario, the premium column will be $2, and the strike price is $105. This is the price at which you are obligated to sell the futures contract if you are assigned. In scenario number 1, the futures price at option expiry is $112. This option will be in the money and you would be assigned. You will sell the future for $105, creating an instantaneous $7 loss on the future. You collected $2 in premium and lost $7 on the future, so your net loss will be $5. For scenario 2, we see the futures price at option expiry is 106. This option is also in the money, and again, you would be assigned. You will sell the future at the strike price of 105 and have a loss of 1 on the future. The net will be a profit of 1. In scenario number 3, the futures price at option expiry is 100. This option is out of the money and will not be exercised. There will be no loss from futures. Therefore, your $2 collected in premium will become your total profit. Scenario 4 has the futures price at 94. This example is like scenario 3. The option will be out of the money and will not be exercised. Again, your final net position will be a profit of $2. Now let's look at the same group of scenarios, but from the buyer's perspective. In this case, you buy a call at 105 and pay $2 premium to the seller. Let's look at your profit and loss potential using the same futures prices at option expiration. In scenario 1, the futures price at option expiration will be 112. This option is in the money. You exercise the option at 105. With the futures at 112, this will result in a gain of 7. If you subtract the $2 premium paid for the option, your net profit will be $5. For scenario 2, the futures price at option expiration will be 106. Again, this option is still in the money. You exercise this option at 105 and make $1. You paid $2 in premium, so your net will be a loss of $1. Scenarios 3 and 4 are both out of the money options. In both cases, you would not exercise the option. Your net loss has been capped at $2, which is the full premium paid for the option. There you have it. 2 views of profit and loss from either side of the same transaction. When looking at profit and loss potential of an option position at expiration, you will need to consider the original premium and the difference in price between the futures contract and the strike price of the option.
Let's look at how put options work by revisiting Susie and Sammy from our earlier story. Sammy owns a truck worth $40,000. He's concerned that his truck might be damaged in an accident or even stolen. So Sammy decides to buy a zero-deductible insurance policy, or a put option, on the truck for the full amount of $40,000, which would be the strike price, from Susie's auto insurance company. Susie charges him $1,500. That would be the option premium for a 1-year policy, 1 year being the expiration date. Now, 3 things could happen in this story. In the first scenario, Sammy's truck is not damaged or stolen during the year. So Susie keeps the $1,500 premium. Sammy's okay with losing the $1,500 for the protection it provided him for the year. In scenario 2, Sammy's truck is damaged in an accident, requiring $10,000 in repairs. He exercises his insurance policy, or his put option, by filing a claim, and Susie pays him $10,000 for the repairs as agreed. Sammy is happy he purchased protection for this possibility. In the third scenario, Sammy's truck is stolen. He exercises his insurance policy, which is his put option, and files a claim, but this time for the full replacement value of his truck, and Susie pays him the full amount of $40,000 to buy a new truck. Sammy, of course, is very happy he purchased protection for this possibility. In any case, Susie's happy because she sold many such insurance policies, different put options, to other drivers, most which never filed a claim or never exercised their options, providing her with a net profit overall. And here's a footnote to this story. If Sammy had a poor driving record, that's more risk to Susie, so she would have charged him more than $1,500 for the 1-year insurance policy. On the other hand, if Sammy had an exemplary driving record, Susie could have charged him less, as the risk would be lower. Likewise, with put options, the higher the perceived risk, the higher the premium demanded by the market. Let's look again at a definition and a trading example. A put option, then, is a contract between 2 parties to exchange a stock, or an ETF, at a strike price by a predetermined date. One party, the buyer of the put, has the right but not an obligation to sell the stock at the strike price by the future date, while the other party, the seller of the put, has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go down to $40, you might buy a $45 put option for, say, 20 cents. If the stock dropped to $40, that would allow you to sell the stock at $45 even though it's valued at $40. netting you a $4.80 profit on each share. On the other hand, the person that sold you the put would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the put expires worthless and the put buyer is out 20 cents and the put seller keeps the 20.